Is it possible there is a big debt bubble? Yes, it is. In fact, there is a debt bubble, especially at a lot of smaller companies, but also at some larger companies. I'll show you a couple larger companies in this video, and I'll show you where to look for which companies might be at a massive interest rate shock potential. We'll look at exactly all of that in just a moment after we look at this Wall Street Journal piece brought to us by course member Max. Course is obviously linked down below. What do we got here? Markets ignore the looming debt peril. Basically, some companies just have too much debt. But so far, investors aren't actually pricing that in. In fact, you could look at some companies like Carvana, which has just exploded, even as people are ignoring the levels of debt that Carvana has, which basically brought it to near bankruptcy last year, which is why it sold down as much as it did. And so the article in the Wall Street Journal here makes the argument that there are three types of companies and business models that are really going to hit the hardest. And this author basically says the market is dashing towards trash right now, being blind about the potential for these weak borrowers to just get whacked. Number one would be, as they call, your most obvious disaster. Super speculative companies that have financed their final stages of production and mostly ended up being SPACs, using debt financing to become these zombies that are probably trending towards bankruptcy. Some of these companies, in my opinion, are probably going to be, although you do have the Saudis backing them, your Lucid, your Arrival, your Canoo. Those are some of the EV highly indebted companies that are getting whacked. Rivian has somewhat separated itself from this, and it's certainly doing better than those that I just mentioned, but not doing great either, with the level of terribly massive negative gross margins you have. Not to include net margins is even worse. It's terrible. I mean, you're spending somewhere around $200 for every $100 of revenue you get. It's bad. But anyway, what do we have over here? Decent businesses. So this is your second type of company. Decent businesses with solid cash flow, but a huge amount of debt. These companies potentially face a reckoning as well. I'll give some examples of these in just a moment and show you in investor relations docs how to look for this. Then, of course, you have offices and hotels. Those are likely to get whacked. And the third type of company is one that might not get hit from a debt point of view, but they're going to end up getting hit from more of an EPS point of view. So you've got these three big risks. Companies that get hit from higher interest rate risks, companies that have a lot of debt but have cash flows, but they'll see those cash flows evaporate. And then basically the only thing keeping some speculative companies alive, which is debt. So what I like to do is I like to take inspiration from articles like this, where they basically talk about wild bets in the stock market being quite risky, and these are some of the red flags you should pay attention to. And I like to go to actual earnings reports. So what I've done is I've pulled up some earnings reports. This is the Walt Disney quarterly report. And one of the things that I noticed with Disney is that even though you have a net income here of $1.5 billion, you have nearly just a little bit above 1/5 of their net income here getting spent on interest. $322 million in one quarter going to debt. That's over 1.3-ish billion dollars of debt a year that Disney is spending. So in other words, an entire almost quarter of Disney's net income is going to debt in a year. It's pretty wild. It's a lot of money going to debt. And a lot of folks are pointing that out over at Disney and saying, well, maybe that's why Disney is performing more weak or weekly lately in the stock market. Of course, you could look at the balance sheet as well. Jump over to the balance sheet. You can see you've got long-term liabilities here of $13 billion, deferred taxes of 8, putting you at about 21 combined. On top of that 21, you've got here short-term bills payable of around 22-ish billion dollars, right here, not considering the deferred revenue. So, in other words, you got somewhere around $40 billion of debt at Disney, with cash sitting around $10 billion. Now, you do have receivables of another 12, but still, that's an extra $18 billion of debt. What's another one? How about Carnival Cruise Lines? Look at Carnival. Carnival Cruise Lines reporting, and they've done very well here since their last earnings over the last week and a half here. But I think this is what's inspiring this Wall Street Journal article saying, hey, people are turning a blind eye to how much debt some of these companies have, and it's a mistake. But look, for example, at Carnival Cruise Lines. You've got interest income of $69 million, but interest expenses of $542 million. You have losses at Carnival of $407 million. In other words, their interest expense alone is driving them into net income. If they had no debt, they'd be barely break even. But look at the actual number of borrowings they have. They got about $4.4 billion cash. You've got short-term borrowings here, or short-term bills to pay of, what is that, 2.7 plus another 2, call it 4.7. You got about $4.7 billion in bills, but unfortunately you've got $32 billion in long-term debts. Yikes, 32 billies. No wonder their interest rate is so high, or their interest expense rather is so high. Now, one of the things that you can do as well, if you go a little bit deeper into these companies, so you can actually start looking when these notes are all due and payable, which is kind of an interesting strategy for trying to evaluate when these companies might have to raise money in the stock market or issue new bonds. For example, you could jump over here. This is just a few pages down from where we just were in the Carnival Cruise Lines set here. And you can see here's about $2.4 billion at Carnival Cruise Lines due in 2028 at 4%. But then you've got about $1 billion here at 10% interest. Look at this, some more notes here. $1 billion at 10.5, $2 billion at 6%, 1.1 at 5.8. And you can see the due dates here with less due here in 2023, but you're starting to get some of these due in 2024. That's where you're really going to start getting a little bit more of your maturities coming through. Although Carnival has really been able to kick the can down the road to mostly what looks like 2026 and 2027, where you're really going to get somewhere around $10 billion coming due by 2027. So while you might have a nice run for the next year or two, at some point the market's going to start pricing in some of the pain coming from debt. And this is a warning and a red flag to start paying attention to. So if you're investing in companies, you really ought to look at companies that potentially have really low debt. Now, I'm not saying go for like super high growth names or SaaS companies, but if you want to see a company that has like a phenomenal balance sheet, like you want to see what a phenomenal balance sheet looks like, do the following. We'll do it together. Go to sec.gov and let's go to filings. Let's search for a company. What ticker are we going to put in? Palantir, PLTR. You ready for this? Okay, hold on. Palantir. Give me my Palantir filings here. I need Palantir filings. Yep, there we go. Better. Okay. Quarterly report. Let's get the last May 9th quarterly report on Palantir. Let's go to HTML here. There we go. Let's look at the balance sheet for Palantir. So, what do we have here? Well, these numbers are in thousands. So, from March 31st, you have $1.2 billion in cash, another 1.6 in marketable securities. That puts you at somewhere around 2.8 billies in cash. Call it 2.9 in cash. You have bills sitting on the table of about $178 million. So in other words, let's make this clear. We'll write it down. You know what? We'll put a little notepad over here, and we'll go 2.9 billion in cash, and then you have bills of what? We'll call it 180 mil in bills. Well, if you want to put this in a billion, just put a period in front of it. And then going back to the balance sheet, customer deposits, deferred revenue, I generally don't look at as debts because you're likely to fulfill unless your business goes BK. You've got some lease liabilities here of another $200 million, but no long-term debt. Literally no long-term debt. So that's it. other than your bills, which is coming from your operating cash flows anyway, you have a company with $2.9 billion of cash and $180 million of bills. In other words, fantastic balance sheet. So that's just a quick lesson for you that it's really easy. It doesn't take a long time to do a quick fundamental analysis like I teach in the courses on building your wealth link down below. It doesn't take a lot of time to do a quick, financial health checkup on the companies you're investing in and go, am I investing in a debt time bomb? And these are important things to consider for your investments, in my opinion. And of course, reiterating what the Wall Street Journal has just explored here. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by